What up, family? LP, your mortgage guy here, back at it with some education. Today's term is APR, or annual percentage rate. Your APR, what it does is measures your interest charges and your discount points, origination fees, and other charges associated with your closing costs, which I went over the video before. Your APR, the main purpose of your APR is to allow you to compare two separate lenders who may be giving you the same or similar conditions. What does that mean, for example? That means is you have two banks, let's just say both of them giving you a 30-year, 6% fixed rate, right? There's another number next to your interest rate, which is separate from your APR. Your APR now will tell you how much each of those banks are charging you. So Bank A, 6% interest rate, 6.125 APR. Bank B, 6% interest rate, 6.325 APR. What does that mean? That means Bank B is charging you a little bit more than Bank A. Now, why are they charging you a little bit more? Could be any number of things. Could be they have a higher application fee. Could be that although they both have the same 6% rate, Bank B could be charging you more to attain that 6% rate, to hold that 6% rate, as opposed to Bank A, who's saying that 6% is par. Bank B might be saying to get that 6% is going to cost you a quarter of the loan amount. How does that affect you in long term? Long term, that affects you this. Short term, it affects you this way. That's affecting your closing costs. How much you have to come to the closing to the table with closing costs. Your check. When you go to the table, if you're a purchase, you'll write a multitude of checks. One will be for the down payment. One will be for the attorney. One will be for the bank. One will be for the, whatever other closing costs. You're gonna write a bunch of checks with the purchase. With the refinance, it'll be included in your loan amount, but that's the gist of it. Now, how does it affect you long term? Long term is you've paid, let's say, $1,000 more with bank. You went with Bank B for whatever reason. Your cousin worked for them. You paid $1,000 more. Now you have to figure out that $1,000, particularly if you're in your refinance. That $1,000 is stretched over the life of the loan, right? That means you're paying interest on that $1,000. Was that extra $1,000 worth it, right? Or if you're purchasing, you just paid $1,000 extra, and you could have got the same rate, right? So that's how the APR helps you. The APR actually helps you decide which bank is charging you less. Where it gets a little different is if one bank is charging you a lower interest rate than the other bank, but that lower interest rate may cost you more than the higher rate. And in that case, you now have to decide if you same loan amount, same terms, if you're paying a higher monthly payment for Bank A, that's 6%, and you would B, let's say their interest rate is 5.8, you're paying a lower monthly payment. Was that $1,000 extra? Was that $1,000 extra worth paying? Or was it not worth paying based on your monthly payment? All right, I hope that helps you out. LP, your mortgage guy, rock on.